Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss front-running commodity seasonality.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today I would like to discuss a topic which is my favorite, and it's seasonality. Once again, let's take a look on our screener, and we have around 100 seasonality strategies in our database, so it's around 10%, 9 to 10% of our database, so it's a quite popular topic. I personally like those strategies a lot. So here is the newest one. The article is called The Trader's Guide to Front-Running Commodity Seasonality. What's the idea? So of course the seasonality is very well known and very important, especially in commodities, because some of the patterns are very easily readable in the commodities. So, and those patterns, they attract the investors who like to make money on the price movements, and this creates a forcing cycle. The question is, what if we could stay one step ahead of the crowd? So what we will try is we will try to front run these seasonal trends. So we will try to see, and I will try to show you how to buy the sectors with expected positive performance before that seasonality months. So before they have their favorable months, you can gain significantly more money than just by playing the seasonality. So it's significantly more important to front run the seasonality, especially in the commodities. Why the commodities? Because the commodities are the most sensitive to the seasonality. For instance, agricultural commodities, they exhibit the price fluctuation based on the planting, harvesting cycle. The seasonal consumption patterns are in the energy commodities like natural gas or other commodities. What are examples? So here we have an example. The article, it's called Pre-Holiday Effect in Commodities, the seasonal pattern in gasoline prices. So that's one of the interesting examples. Another one is, for example, there is seasonality in the gold, the autumn effect or Halloween effect in the gold. So there are just like a few of the examples. There are a lot of the other examples of the seasonality movements in the commodities. What is our investment universe? We use the investment universe which is the same as in our previous article, how to improve commodity momentum using intra-market correlation. So we are using the ETFs. The added advantage of the ETFs is that they are diversified. So it's not about just one commodity, but we are using the diversified commodity sectors. So agricultural fund, the base metal fund, energy fund, and precious metal fund. Use those 4 ETFs. Plus another advantage is that it's easy to trade, and we have data from January 2007. We don't need to take care of any rolling or and stuff like that. So it's very easy to trade the ETFs, and those 4 ETFs, they have the long history. So it's very easy to build strategies on them. What is the idea? First, the hypothesis is that there exists some seasonal play. So the performance in the month X, so in the February, can be predicted by performance in month X minus 12. So in the previous year, February. That's just an example. So we could predict February's performance based on the performance of the previous February. What the idea? So let's build a naive seasonality strategy for those commodities. So at the end of each month, we go long or buy the sectors with the seasonality in the top 50% with a weight of 20% per sector for the coming month, and we sell or short sectors with the seasonality in the bottom 50% percentile with a weight of minus 55%. So what does it mean? The easiest is to have an example. So at the end of January, we check the percentile rank for each ETF, so the performance for each ETF, monthly performance of each ETF over the last 12 months for DBA, DBB, DBE, DBP. So we check the monthly performance over the last 12 months, and then we check the DBA's performance. We are looking at the end of the January, so we check what is the DBA's performance over the previous year, February, and we realized that it's 25th percentile of all 12 months, so it was not very high the last February. In DBB example, it was 75th percentile. In DBE, it was 83rd percentile, and DBP was 83rd percentile. So what does it mean? So at the end of the January, we go long 3 ETFs. So DBB, DBE, DBP, because their percentile was higher than 50. So the performance in the February in the last year was higher than the 50% of the other months over the last year, each with the 20% weight. And we will short one ETF DBA with a minus 25% weight. So as we can see, the total net position for the strategy can be between minus 100% if we short all 4 ETFs or plus 100% if we go long all 4 ETFs. There is an advantage of the construction of the seasonality strategy in this fashion. The net ETF position is between minus 100% and plus 100%, which is very simple. Plus we are using the time series seasonality definition. So we are judging each commodity on the individual basis. So we are not checking what is the performance of that commodity compared to all of the others. So it's not the cross-sectional basis, horizontal seasonality on a cross-sectional basis, it's a time series seasonality. So we are looking on each individual commodity and comparing the performance over individual months on just that one commodity, and I mean we go sector by sector in this way. Of course, it's also possible to buy the cross-sectional seasonality strategy, but I mean this is not the case for this article, so we are just looking at the time series seasonality definition. So here is the preliminary outcome. The purple line is a benchmark, so it's equally weighted universe for ETFs we are using as an investment universe, and the blue one is the model. So as we can see, I mean it's completely disappointment. So we have negative performance, we have a negative drift, significant negative drift over the whole backtested period, so over the last, I don't know, 15 years. So what does it look like is that there is even a reversal in the seasonality. So previous year's February negatively predict performance of the current February. Why it is so? Our hypothesis is very simple. So there are sophisticated market participants, they know about the strong seasonal tendencies in the commodities, and they are front-running those seasonal signals. So our hypothesis is, therefore, instead of, trying to determine what should we buy at the end of the January based on the February performance, we are let's try to front run. So at the end of the January, buy the commodities that have the great seasonality in the March, because we are trying to front run them. So in February we are trying to gain some money by going along the commodities that have a good seasonality in the March. So that's the front running. So we are front running the seasonality. That's what the sophisticated players are doing, or they would do in the market. So they will front run the naive strategies. So our alternative hypothesis is that the performance in the month X could be predicted by the performance in the month X minus 11, not X minus 12, but 11. And here we have a strategy, and it looks significantly better. So we can see that there really is a front-running effect within the commodity sector seasonality patterns. So the strategy that plays a naive seasonality has a significantly negative performance. On the other hand, the strategy that front-run the seasonality has a significantly positive performance. The difference is in extremely opposite direction. So our model 2, front-running the seasonality strategy, has a performance over 6%, Sharpe ratio over 0.5. So it's a very interesting strategy with maximum drawdown 20%. So this is very interesting. What's our conclusion? Yeah, it may be a good idea to include seasonality patterns in our trading decisions. But it's important to keep in mind that the financial markets are adaptive. So the naive seasonal strategies may not be the best idea. So we can, proactively time shift the signal, and we will get a better performance. So let's front run the seasonality strategies. And we have another addendum to this idea. So what is the impact of the correlation? Here we have an article, how we can improve the commodity momentum by using intra-market correlation. So we are comparing the long-term correlation and short-term correlation, or intra-correlation between the sectors. We see that there is significant impact on the momentum strategy. So the momentum works well when the short-term correlation is higher than the long-term correlation. Here we have another pattern. So the seasonality works significantly better when the short-term correlation is lower than the long-term correlation. And we can improve our front-running model by using the correlation filter. We'll have a higher performance, lower volatility, higher Sharpe ratio, lower maximum drawdown. All of the risk-return ratios are better. That's a little surprise. We had a theory that short versus long correlation can be used as the predictor, but it improved strategy significantly. The main hypothesis as to why the seasonality strategy performs better when the short-term correlation is lower is mainly due to higher dispersion of the commodity market in this state. So when the short-term correlation between commodity sector is low, it's evidently easier for the seasonality strategy to pick or to distinguish the seasonal signals from the noise. And it's significantly easier than in the state when the correlation among the commodity sector is high. And in this case, they may trend all in the same direction. So it's easier for seasonality to distinguish between the bad sectors and the good sectors when the correlation is low. You can significantly improve the front-running seasonality strategy by using the correlation filter. So I hope that you liked this video. In case you like it, please give us a like on YouTube, drop a comment if you have any question. Do not forget to follow us on our YouTube channel or our social media channels, Twitter, LinkedIn, Blue Sky, Facebook, etc., etc. Do not forget to visit our blog and visit Quantpedia, and I hope that you will join me in the next video. So thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.